Coinbase was founded in 2012. Fast forward to 2022, Coinbase is the biggest cryptocurrency exchange in America, and it just launched its platform in India. Coinbase is also teaming up with Bored Ape Yacht Club and ApeCoin to create a movie trilogy, and it will be the first of its kind of project. Coinbase Entertainment, the new media arm of Coinbase, will be working on it. But there is something darker hiding in the shadows, and it is concerning. Coinbase has been accused of insider trading. Today, we are taking a look at why Coinbase has been accused of insider trading. Stay with me until the end to learn about the story of how someone purchased hundreds of thousands of dollars worth of tokens 24 hours before it was officially announced on the Coinbase asset listing post. Also, if you enjoy finance content, consider subscribing or liking the video. I spend a lot of time researching these stories, and only a small percentage of my viewers are subscribed. It's free and you can always unsubscribe. So, everyone in the crypto space knows that Coinbase listings have a big impact on the market. Tokens which are listed on the platform have shown to generate significant gains, time and time again. Even rumors about coin listings have surged the prices of many tokens. But this time, the rumors swirling around the internet are about Coinbase insider trading. On April 11th, Coinbase published a blog post about 50 altcoins that they are currently considering for listing. Just hours after Coinbase published that blog post, crypto Twitter personality Kobe flagged an Ethereum wallet that purchased more than $400,000 worth of the tokens on that list. The problem is that the user who controls the wallet, the trading activity of which is publicly viewable on the Ethereum blockchain, wrapped up their token shopping spree 3 minutes before the list was public knowledge. That is kind of suspicious. Kobe's tweet said, "Found an ETH address that bought hundreds of thousands of dollars of tokens exclusively featured in the Coinbase asset listing post about 24 hours before it was published." He wrote, including a screenshot that showed big purchases of indexed, Chromatica, DApp Radar, RAC, DFX token, and paper. The trader clearly focused only on tokens that were under consideration for listing on Coinbase, which means he had advanced knowledge of the list before it was published. The tokens purchased by the wallet are now worth more than $572,000, amounting to a 42% return on investment in less than 24 hours. This is a classic case of front-running. What is front-running, you might ask? Well, front-running is when a trader takes advantage of an insider tip or knowledge about a future transaction that is about to substantially affect the price of a crypto coin. So essentially, the traders buy or sell a crypto coin based on advanced, non-public knowledge or information that they believe will affect its price. That information is not yet public, giving the trader an advantage over other traders and the market at large. And in fact, front-running is a form of insider trading and market manipulation. In this case, the listing of a cryptocurrency on a major exchange like Coinbase. Because of the liquidity Coinbase's big customer base provides, the listing of a token usually sends its price up. The owner of the digital wallet in question has not been revealed. It appears that cryptocurrency influencers who have done their investigation on the matter believe the wallet is owned by a Coinbase employee. Coinbase hasn't acknowledged the unusual and potentially unethical trading on either of its Twitter accounts. As a publicly traded company, Coinbase is required to report instances of insider trading in its shares. But crypto? With the US government still unsure if tokens are securities or commodities, it's not clear who could or would take action. There's a history of crypto exchanges having trouble with token listings. In 2019, there were allegations that employees had bought Bitcoin Cash ahead of its listing. In 2021, the CFTC investigated Binance for insider trading. Binance said at the time that it had a zero-tolerance policy against insider trading. But until legislators and regulators resolve some of the big questions around cryptocurrency, enforcement may continue to prove problematic. Silicon Valley investor Rob Siegel, a Stanford Graduate School of Business lecturer, said, "It's hard to know if the Coinbase announcement and Kobe's claims are related." He also said that embracing a new policy for token disclosures makes sense for Coinbase, given that crypto is desperately trying for legitimacy. In many instances, disclosure is good for conflicts of interest. Perhaps this is just Coinbase doing good governance and pushing it now so as to stay clean. The timing of Coinbase's announcement remained an oddity for some. Public opinion is divided. Some believe insider trading was at play while others think it's pure coincidence. Alex Johnson, the author of the FinTech Takes newsletter, said the Coinbase blog post makes it seem an awful lot like Coinbase knew that someone had an information advantage and had already acted on it. Publishing this blog post about token consideration seems more like a weird attempt at damage control than an attempt to prevent this problem from happening again in the future. Crypto insider trade is a common issue. Crypto heads have expressed their anger over the incident on social media, criticizing US regulators for focusing on regulating the wrong aspects of crypto. The space has had several instances of insider trading in recent months, but no legal action against such trades has been taken because the wallet addresses do not betray identity. The United States also has no clear regulation in place to prevent or punish insider trading in the crypto industry. On the other hand, the world of NFTs is no stranger to insider trading either. A high-ranking employee of the largest NFT marketplace, OpenSea, was found to have traded on insider information. Nate Chastain was head of product at OpenSea. By virtue of his role, he knew when certain NFTs were going to drop. He took full advantage and placed orders for these non-fungible tokens just as they appeared on the marketplace, ahead of anyone else who, of course, didn't have the inside knowledge. The fallout was fast. OpenSea issued a statement acknowledging the wrongdoing, but he wasn't fired. Less than 24 hours later, a new statement appeared. Chastain had resigned because the marketplace had asked him for his resignation, and he resigned under pressure. Chastain's insider trade started a conversation about regulating the market for non-fungible tokens. This would prevent the public from getting fooled by insiders. In regulated securities markets, trading on material, non-public information is generally illegal. It is punishable with hefty fines and potentially with prison time. There is some uncertainty among experts whether Chastain violated existing laws. For the time being, he has slipped between the cracks. But there is more to the story here than just cowboy trading and a need for more laws and sheriffs. The nature of crypto itself, as well as NFTs, adds a dimension of self-regulation not found in most other markets. Here is the important aspect of the situation worth considering. Chastain's deeds were uncovered not by a government investigator, but by an ordinary person through the unique properties of blockchains. Because every transaction on a blockchain is immutably recorded and publicly accessible, Chastain's paper trail was discovered by someone on Twitter. A tweet with evidence went viral, and the rest is history. Blockchains create somewhat of a transparency paradox. Because all transactions are permanent and public, they provide unprecedented financial transparency. This means that anyone attempting insider trading can be caught by other people, and no government agency is required. However, transparency may be a double-edged sword because it means users are constantly attempting to protect the anonymity of their transactions, sometimes for good reason, and sometimes for crimes. While insider trading is an obvious threat to the stock market, it is less obvious to the cryptocurrency exchange. Perhaps that is because of the recent age of crypto in general, or perhaps that is owed to the security and decentralization offered by blockchains. Either way, insider trading can plague any market that allows trade. Did someone working in close proximity to Coinbase use insider information, or was it just a coincidence? Let me know what you think in the comments below. And if you learned something new from this, click the subscribe button and hit the bell icon to be the first to see our new videos. I make deep dives like this every week where I uncover the secrets of money and business.